Hi everyone and welcome to another edition of Between the Lines Live. Actually the first one for 2024, so welcome back and Happy New Year and Happy Valentine's Day for those who are celebrating. My name is Vanessa Rader, I'm the Head of Research here at Ray White, and I'm joined today by two great speakers, so it'll be great to see what's happened in 2023. We'll talk a little bit about that and what's going to happen looking forward. So firstly we've got Samuel Hadgelias. Sam is the Managing Director of RWC SC based here in our Sydney head office. And we've got Scahill, Group Executive of Commercial Lending at LMG. So welcome, guys.
Thanks, Vanessa.
So exciting to start the year. So let's start by looking, well, firstly, this year starting off reasonably optimistic because we had those inflation numbers that came out the other week start coming down. A lot of people now all of a sudden talk about interest rate cuts, which wasn't kind of people talking about so early in the piece, just only a month ago. So good news story. So can you tell me a little bit, Sam, we had a tough 2023 when it comes to commercial, volumes were down, it was a difficult market. Can you give me a bit of a wrap up of what you kind of felt during that tail end of 2023 and
Sure.
some thoughts of, and then we'll take it forward of what's going to happen.
Yeah, absolutely. I think 2023, like the two words that probably summarise that for me were challenging and inconsistent.
Yeah.
It was challenging if you're an agent, if you're an owner, if you're a buyer in the market for all the things that you just mentioned, where there was a lot of sort of uncertainty around what was happening with interest rates. Inflation was still obviously high, and there was no sign that it was immediately coming back despite these continual hikes. We had a lot of people say that they were really struggling to, even those that were interested in purchasing, were struggling to get finance. So we had a big makeup, which was just creating this market where people just weren't sure what to do.
Yeah.
I say
when people aren't sure, they do nothing.
Correct.
They
So
sit
you
on
had
their
a lot
hands.
of people that just said, you know what, yes, I'd like to buy, yes, I'd like to sell, but I'm just going to wait and see because I'm just not sure.
Yeah.
And as we moved through the year, that we sort of kept having these little bumps and forecast changed, and no one was just 100% certain about where we were going.
So feeling a bit more optimistic
Without a doubt, and I think the other thing I'd say, as I said, inconsistent was the other word, because despite the challenges that we had there, we still saw some outstanding results in the market. And it was really difficult for buyers to sit there or anyone in the market and understand really what the theme was, because the theme kept changing.
Yeah.
And I think you hit the nail on the head as we head into 2024 already, even in the last 2 weeks since we've had this updated inflation data, you've seen that the sentiment's changed. We've seen sort of there's more excitement in calls that you're making. People are out there with briefs. People that were sitting on the fence are going, okay, my time's come. I might be ready to do something. And I think we're really going to see a lift in transaction volumes as we head through 2024.
Yeah. And Steve, so Steve, you're from LMG. So do you want to tell us quickly a little bit about your role and who LMG are?
Yeah, sure. So we're an aggregation group. So we've got 5,000 brokers across Australia and a largest group in New Zealand as well. And within that, we've got a subset of brokers who are focused purely on commercial lending, or they're primary commercial specialists. So what my team does is sort of propagate commercial lending. Aggregators have typically been more focused on the residential lending, whereas our team's sort of dedicated to how we grow our commercial flows. In terms of what we experienced last year, we actually ended up in 23 on par with 22. So that was a really good result. But it wasn't a linear journey. It was very back-ended. We sort of went through a period during the middle of the year where, off the back of, 13 consecutive rate rises, that people, as you say, were sitting on their hands.
Yeah.
And I think the messaging that we needed out there wasn't necessarily that rate cuts are coming, but we've probably reached the end of the rises. Mm-hmm. And that, our brokers reported that was when the sort of sentiment, started to change from their
confidence is such a massive thing. Like the change, and also then the sentiment starts to shift. People start doing a bit more activity, and that's it. It's kind of we're all jumping on the bandwagon. Confidence improves, and it's hopefully a much clearer 2024 when it comes to the commercial space. So with that, let's probably talk through a few of the asset classes. That would be a pretty interesting one to do. So what I want to start on is actually development sites. So development sites obviously is a commercial investment. And I want to talk about development sites because they had a really rough last couple of years, to be completely honest. Construction prices grew ridiculous. So the feasibility of a lot of these things made it quite difficult. We've started to see that moderate, still growing, but it's definitely moderated. But the flip side, we've got a huge population. It's not a New South Wales story, around the country, more of a Queensland story really than anywhere else. WA as well. We've seen house prices, unit prices really rise considerably despite those interest rate movements. The lack of rental stock with all these people coming on. So one would think that development sites are tipped for a bit of an improve this year. What's your thoughts on that, Sam?
I agree with you. I mean, even this morning, Vanessa, there's an article in the paper, and it's almost daily where we're getting these reports about undersupply of stock, about population growth, and about it's now becoming this sense of urgency. So the fact that we saw very minimal transactions in this space last year was certainly surprising. And it all, again, comes down to the feasibility element. And we had values holding, that's great. We think that we might have finance move a little bit, that's even going to be better. And I think what we need to see is people having more confidence that those construction costs are starting to come back. And that's when I think we'll have people go out and start new projects. I'd also say, there was a big development science incorporates a lot of things, right? So we go low, medium, high density. If you were low density, medium density, and if you are townhouses, duplexes, that sort of thing, the demand for that is still extreme.
Yes.
The smaller the amount of excavation, even better. People can get in there, they can keep those construction costs low, and they've got to keep their teams moving.
Yes.
Where that feasibility died as you get into that higher density market.
Yep.
And I think that's where we're probably going to see, there's a lot of, we speak to a lot of owners every day, whether they be developers or builders, they've got sites. They might not be ready to deliver them, they might want to flick them on, and they're getting ready to make those decisions. So I think we'll see them come back to market. And I think we'll see those guys that have probably been more focused on delivering their existing pipeline come back into the purchasing side, because these are now being delivered and they're ready to restock.
Yeah.
So if the feasibility works with us, if those construction numbers continue to come down a little bit, I definitely think we're going to see a big uptick in confidence and in transactions for that.
I suppose there's the construction price element, but also that labour piece, and I think that there's been some improvement in that labour piece as well. So
reportedly,
so that's a good news story.
Absolutely.
And also planning those is continue to be a stumbling block. So you could have, and we're talking about things that don't have a lot of excavation. So big englobo sites.
Yep.
Primed for subdivision,
Yep.
as long as we can get through the servicing and the delivery via the planning mechanisms, it should be a no-brainer that those things come to the market.
I agree.
Yeah. And in terms of, so obviously the finance piece is a massive part for the development site market, so the construction finance as well as the actual land financing. Is there much of an appetite by the banks or your lenders that you're dealing with for this sort of product?
Yeah, there is, and certainly it's stronger than it has been. But the appetite, particularly amongst the banks, is for high quality projects. That they want an area that they believe in, and they want to work with a sponsor that has a track record.
Yep.
So someone that's delivered in the past, and particularly potentially with that bank, that would go a long way. I think what we're seeing is that a lot of the major banks, and this is probably where we say the bit about views are those of my own and not anyone else, but they've got big portfolios, and some of that is linked to the office space, CBD, and they know that there's this revaluation that's coming. So they're really looking to bolster their portfolio with quality stock that will lift the overall quality of the portfolio. So I think that's what we'll see, that there's appetite, and some of the lenders are actually quite open to do business, but they want to make sure that they're good quality developments that they're participating in. And
also who they're dealing with. Like, obviously the building sector has been devastated over the last couple of years, a lot of builders falling over, and that's obviously a key consideration for them.
100%. Having that track record that I've delivered on a project previously, and particularly if you have that relationship with a bank and you've proven to them in the past, that goes a long way. That being said, one of the beauties of being a broker is that you have access to a number of lenders. We've got 30 plus commercial lenders that sit on we partner with, and there's probably some solutions, that won't be met by major banks. And there's a range of non-bank lenders that are really pushing hard into that space. Talking with one of them recently, they used to do a weekly view of, let's have a look at all the development opportunities in their pipeline. What are the ones that, the projects that they want to bank? That's now a daily meeting.
Wow.
Yeah, wow.
Simply because the amount of opportunities that they're seeing.
So second-tier lenders were such a feature of the market for the last few years, across all asset classes. But so there's definitely still an appetite for those second-tier lenders.
Absolutely. So for those non-bank lenders, they really are, filling in the space that some of the stuff that majors were previously doing. And then there's a group of lenders that I guess previously we referred to as private lenders. And I'm not sure if that name's appropriate into the future, because some of these are really well funded. They've got their own lines, and again, they're probably more aggressive. But there's a price. They're more sort of a rate for risk basis. They've still got to believe in the project. They've still got to have confidence in it. But they certainly will be more aggressive than, say, your banks or non-bank lenders.
So, Sam, the sentiment obviously is probably ringing true about what Steve is saying. Location,
Without a doubt.
location just
Yeah.
is key.
I mean, it's the age-old, the location is sort of the foundation of real estate, right?
Yeah.
And we saw that sort of happen last year and continue into this year. It goes without saying, if you've got a site, probably regardless of the density, that's in sort of a high-profile blue ribbon area, that's in a high-growth area, that's in a site with sort of major undersupply or a little bit of undersupply, that gives that extra bit of confidence, because the developer can have more confidence because they know that their bank that's something that the bank's going to look at.
Yeah.
If you're sort of in an area that's sort of inundated, where your pre-sales are going to take a long time, where that's where there's a little bit less certainty around what the future of that market looks like, that's obviously when that was giving people pause for thought.
Yeah. And the infrastructure as well, like public transport, those sort of things. There's obviously so many infrastructure projects going on around the country.
Of course.
However, needs to be a bit more advanced before we're seeing a lot of take up of that kind of development site stock. Are people getting in early, or is there a trend to that? Or
I think it's a little bit of both. There's certainly a lot of inquiry at probably the earlier stages for that, and that you see comes down to, I suppose, terms. So if there's a bit of planning risk around that, if there is a little bit of uncertainty around sort of how long it might take, even if it's not planning, if it's more sort of council driven, you'll still find that you can create urgency and excitement if the vendor might be prepared to give a little bit of some terms around that.
Yeah. Give
a bit of time so that gives the purchaser some time to go away and do their homework. It's not about due diligence. That's almost a swear word in agency wherever possible, but it is like settlement time can often be very helpful. So you might find that you get to the same price if you can offer sort of more favourable terms around timing.
okay, well
So it's interesting you talk about the infrastructure projects and the discussion you had earlier around availability of labour. Certainly some of the reports we're getting, particularly out of Victoria, is that for some of the smaller developments, that's posing a bit of a challenge. Just that there is so much infrastructure work going on that some of the builders are having difficult access to trades.
Yeah.
Yeah.
Yeah, well, that's exactly right, because then they're just in direct competition with, everyone else that wants to try to do some building and renovating.
Yeah, and that obviously then blows out times as well. When you can't get the trade, that delays your project, which creates an issue back with the bank or your funder or your private lender who's waiting to recall money, and through no fault of your own, weather events, you're delayed.
Yeah.
So, that certainly brought, I think, a little bit of distress and probably some distressed assets to the market that we saw last year, which was a direct result of, labour shortage and things like that.
So that's development sites. I just think it's going to be the year of development sites. We're going to see far more activity happening in that space, and not residential, but as well as the industrials and things of the world too.
Absolutely.
But on to more kind of traditional commercial asset classes, office. Everyone probably knows I'm pretty down on office. You can't dispute. The recent data from MSCI came out, and all the returns are pretty dire. But okay, occupancy is still pretty low, but that's an opportunity, massive opportunity for people to get into the market. Retail, we've seen more retail sales at the start of this year than any other. We're seeing a lot of people jumping onto retail, little centres and individual shops, and much more activity. And then there's industrial. Industrial has been the golden child for so many years, and if you're looking at kind of returns and things, still doing reasonably well. Do you have what's your thoughts on those kind of traditional markets? Do you think one's going to get ahead of the other, or is there going to be more activity people are going to stay away from?
Look, I don't necessarily know that people will stay away from certain asset classes, like especially your owner-occupier. If they've got a demand for it, they're going to buy it. I think if you're an investor in the market, industrial definitely still a big flavour. You generally find that your covenants are a little bit longer if you're an investor coming in there, or you're an owner-occupier that needs that space. And industrial is still so limited in supply, and I think that's sort of big part of the reason that we've seen such a spike in those values and continued demand.
Yeah.
And we're already seeing that a little bit this year, as much as sort of assets are just coming into the market. I think sort of in terms of other asset classes, anything from an investor perspective that has sort of a guaranteed return, and sort of by that, whether you're talking about sort of service stations or a covenant that might be listed or that might have sort of certainty of tenure, I think is going to give people a lot of confidence. And in the absence of that, I think you just made the point about retail, sort of little centres where you have diversification of income, so not all your eggs are in sort of one basket. I think that's going to be really popular, because you can stomach one vacancy sort of here or here if you're buying an asset that might have sort of multiple different components, and that just gives you a little bit of comfort. If one goes, I've still got, I'm not sort of there holding the baby, so to speak, for everything. So I think it'll be those diversified income and a bit of industrial that goes along there as well.
And for you, Steve, so is there any, with your broker network, is there any particular asset class that seems to be getting more inquiry or more popular, that you're doing more deals in the commercial space?
Yeah, health is almost an ongoing
So we're
one.
moving away from the traditional office, retail and industrial, and we're going to the alternates, right?
Yeah. Well, one thing that's, I think, really interesting around the office space is we've seen a couple of Australia's largest employers come out and have policy now around sort of work from home and how often you need to be in the office. We have in sort of labour surveys, often the number one thing is flexibility. So it does feel, I don't think we've landed. It does feel like what the employee is saying that they value and what the employer is setting as an expectation. I think there's a bit to play out there. And my view is that we'll see more and more people back in the office on a regular basis. Yeah,
I think that's just going to take time to play through. But how that translates to actually occupier demand, and that means rents rising and then values of assets coming back up is a different story. But no, I don't mean to interrupt your medical discussion. Let's talk about medical.
Oh no, so look, we've just seen that that's a popular area. I think probably the trend more in our industry is around brokers specialising to a particular industry. Often a commercial broker was a commercial broker. Now we're seeing more and more say, I'll align myself to pharmacy, I'll align myself to the hospitality industry, and become childcare's a big one, become deeply specialised. And the advantage of that is lender appetite for credit, it's not static. Often a lender, will say, I'm all in on this particular area, and they have a big run on it, and then all of a sudden, I need to balance my portfolio, so I'm not after as much childcare as I was previously. So having someone who spends their time deeply understanding the market for a particular industry type, we've seen that that they've got some really good results for their customers as of being so close to it.
Well, that makes sense. Because the offerings of all the lenders change all the time, and like you said, their appetite changes for those sort of alternative assets, and they have over a long
they've got
period of time.
portfolios to balance.
Yeah, that's right.
Yeah, absolutely. And the smaller the lender, the more nimble or agile they'll be, and the more reactive that they need to be. That for some smaller lenders, a couple of really big transactions absolutely changes their outlook on an industry type.
You've had some success with this kind of the alternative sector. You've been doing a lot of work in that. Like it's been a massive commercial investor for the last, asset class for people to invest in. I remember doing a piece late last year, and we looked at year on year, and it just kind of, despite the fact that volumes totally had kind of fallen, that part of the pie kept on growing. Do we think that we're still going to see that coming into this year, or do you think there'll be a bit more, consideration around other factors? Because it got to a point where you kind of felt people were just jumping in and buying well, it had a return, but now with the cost of finance being so much higher, will we see some of that kind of demand for those, service stations and your childcares and your kind of come back a little bit? Do you have a thought on that?
I don't know necessarily that the demand will come back, and I think alternative asset class is so broadly encompassing, right? So it can refer to, we've mentioned childcare, we mentioned service station, medical. I think boarding houses probably sort of fit into that category as well, and definitely seen a bit of an uptick in demand for those. I think if we look at, obviously we talk about undersupply of rental availability and of diversification of income, that's really charging sort of people into that space. I'm marketing one at the moment. Interest has been outstanding, and once upon a time those sort of assets were really hard to lift. I think childcare is still going to be popular. We've got a lot, childcare's been massive for now a couple of years, so we have a lot of centres, and we're going to get to some areas which are now oversupplied. Yeah. And so I think, and we also, as new asset classes sort of come through, people get more and more educated about them. There are now 3 or 4 websites that people can jump on, and they can have a line of sight over what the actual demand in that area is. I don't need to tell you this, but in seconds. So you've got, yes, I do think childcare will be popular, but I think it will be sort of area specific, and it will depend on what that supply is. And the same goes for sites. Medical's probably a little bit sort of less subject to that. If you've got a strong covenant, again, if you're going in and buying an asset, either as an operator, you're looking for, you're a bit emotional because you need a premises to actually, that it's going to work for you as an operator there, or you're buying a tenant that sort of has set up their practice there and they intend to be there for a while. So you've got that sort of security there as well. So I think that'll continue to be strong. I think those that probably bought a couple of years ago, where cap rates did get very, very tight, sort of if they were trying to resell in sort of the market that we've just been through, where obviously we have seen an adjustment, that's been hard, but these guys are probably going to elect to hold until we see that sort of balancing act a little bit. So definitely. Hard to put your finger on it, but I think there'll be activity.
The boarding houses, that's such an interesting one, because a lot of people think boarding houses and they think some pretty bad things, but they're pretty, the ones that have been built in more recent times, they're high quality assets, and they really serve the need of this kind of housing issue that we do have across the country. Without a doubt. And they're a lot of demand for them. There has been for a number, they're quite tightly held, some are particularly blocks of units. Blocks of units, another one, kind of those, a mixture of old and newer apartment buildings, sometimes strata, sometimes not. Great exit strategies there as well, but a lot of demand.
NDIS, disability housing,
absolutely.
It's and finding the right funders for that isn't necessarily always easy, but there's tremendous demand, and sort of great opportunity.
So a piece I wrote at the end of last year, and I remember chatting to you about it, Sam, and I think I had block of units actually as our number one kind of, or my number one kind of pick for this year. It just makes a whole lot of sense. The undersupply, the rental growth, and the multiple exit strategies you've got from an asset that's residential is pretty fantastic. So what's the opportunity then? What do you
unit blocks?
What's the opportunity for 2024? Commercial, all things. I'm not going to do the whole if you've got them, $10 million or $100 million, what are you buying? For sure. But you speak to a lot of people. There's a lot more inquiry. People are feeling a lot more upbeat about this year.
I think sort of anything that has the opportunity for sort of to manage your risk a little bit is going to be really popular. We spoke about sort of strong covenants there. I'm going to use unit blocks as an example. People love them, and they still transact on really sort of tight cap rates, because you've usually, and not all of them, but you've got an opportunity here. Vacancy is often quite low, but again, diversified. You repositioning, or as in sort of, you've got the opportunity in some of them to strata and sell them down and maybe sort of refunction some debt around that, or obviously redevelopment as well. So a lot of these in sort of high density areas, you've got other things going up around them. There might be a land bank now with sort of opportunity for the future. I think that's we're going to see sort of more of that come into the space, but there's only so many. They're not going to be able to transact forever.
And whoever owns them though, they're they're holding on to them because they're great assets. And if you land banking them, you're not holding on to them. And there's a lot of privates,
Absolutely.
older privates that own these assets, and that's.
And once upon a time, these sort of things transacted sort of on wholesale, really. But now we're
Yes.
kind of getting to a point where they're actually sort of you're paying a little bit more than retail. So you've sort of got to be careful as to how these things are sort of priced, and the demand will depend on sort of what the outcome is of that and what the alternatives for the asset are as well.
So while that's the pick for the year, where do you think there's some opportunity? Is there opportunity in things like a lot of people always talk about the repositioning of office into like living sectors, which can't happen. It can happen for really older style assets that still have natural light and high ceilings and those sort of things.
Yeah.
Is there any other kind of asset classes that you can think of any kind of major opportunities, or is it just be ready, look at the because there's going to be distressed sales. What's your thoughts on distressed sales for this year?
Oh, I don't look. Everybody, even if you go right back to the beginning of COVID, everybody was sort of waiting for this cliff that was inevitably coming, where sort of there was going to be this free fall in asset values, and we just haven't seen that come through, and we haven't sort of seen that volume of distressed asset sales come through, or at least that we know about. There's a lot of people out in the market that are probably sort of, making their own decisions to sort of sell before the decision is kind of taken away from them, and that's not a one size fits all approach by any stretch. But I think that those coming into the market now, it's all about sort of the urgency in the sale. If you're selling a property now, or you've probably got a genuine appetite to, might not be a need, but you're selling it now because you want to redeploy the capital that you've got into another opportunity. And so I think anybody that's out there buying is going to see good opportunities. They might not be dirt cheap, but they're probably sort of solid market investments.
Yeah.
If it's priced right, if you create a little bit of urgency around it, and if you're you create some social proof by being in the market, my view is it'll sell.
Yeah. Okay.
And I think our lenders do deserve some credit for the way that they've worked with customers in more recent times. There's a tremendous amount of support was available through COVID. We've got, with the rates continuing to rise, there's some financial covenants that haven't been met, that they're now working with them. How do we get a good solution? So I think this the first reaction of sell it up or it becomes an asset that has to go, I think we're a little past that. And I think that's a constructive way to look at this. There'll certainly be people that will fall into that category, but hopefully, most there'll be equity and the ability to get out of these situations. But I do think the attitude by a lot of our lenders has helped that.
And just to probably the last point maybe is with the lenders, is there something that someone can do to their property or that makes it more attractive to financiers, or is it really more about the relationship that the prospective purchaser has with the lender, or is anything that property specific that can be done, or is it just more about the relationship?
I think less property specific. I think it's more about finding the right lender with that appetite. So shopping it.
Yeah.
If the ability to have someone scour the market for you. Not everyone has the same appetite. Not everyone views each asset the same, and some will be far more aggressive on price if that's a segment that they want to bank. So I think it's probably the best tip is to sort of have a look around the market and see what terms you can attract.
Yeah. Well, I think that's all we really have time for today, but this was a really great chat. So thanks so much to Stephen and to Sam for joining us and talking all things commercial property and lending, which is great to have you come and talk to us from LMG. So thank you, everyone. As always, you can go back and watch this or share it with your friends, or your contacts, your clients, whoever it is, on YouTube. You can also, later on today, I'll pop that on our Spotify channel. So as always, jump on, search Ray White Commercial Between the Lines Live. Any of those kind of words you put in there, you'll find it. And feel free to listen to this one and go back and to listen to some of our other ones. Last thing I told, Carolyn Cummins, if anyone knows who she is, she's the property editor at Sydney Morning Herald. It's her birthday today, so happy birthday. And if you know her, please send her a message and wish her happy birthday, because Valentine's Day often gets lost. And the last thing is next month. So we're back on track. We've got a pretty full year of Between the Lines Live events coming up. The next one is on the 13th of March. I'll be here in Sydney, and it's going to be a really good one. It's going to be about the hotel market. So we will have Adam Ellis from our valuations team and also Andrew Jackson from HTL talking about accommodation hotels. If any of you read my piece I just came out this week talking about Taylor Swift and the effect on hotel prices, you'll love to tune into that one next month. So we'll see you next month, and feel free to share, like, all that sort of thing with all of our information that we've got. It's really exciting to have you guys on board. So see you next time.